Welcome to StokTok's deep dive into China Construction Bank Corp. This is one of the world's largest financial institutions, headquartered in Beijing, and a systemically important lender across mainland China. The bank operates through retail banking, corporate banking, investment banking, and asset management divisions, serving hundreds of millions of customers and businesses across the country's financial system. As of May 8th, the stock is trading at $1.04. Over the trailing 52 weeks, the shares have ranged between 84 cents and $1.31, placing the current price near the middle of that historical range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. China Construction Bank is fundamentally a deposit-taking, loan-originating institution operating across the full spectrum of Chinese banking. Its competitive position rests on scale. It is among the largest banks by assets in the world, combined with implicit government support and a dominant position in mortgage and infrastructure lending. The bank generates revenue primarily from net interest income, which is the spread between what it earns on loans and what it pays on deposits. Secondary revenue streams include fees from wealth management, investment banking, and asset management services. The moat is substantial but fragile. It derives from regulatory relationships, cost of funds advantages via state backing, and network effects from its retail deposit base. However, the broader Chinese financial system faces structural headwinds including slowing economic growth, rising loan defaults, and property sector stress. Our StokTok score for China Construction Bank is 33 out of 100, a signal to avoid. The company scores 14 out of 20 on valuation, 9 out of 20 on financial health, 10 out of 20 on profitability, 0 out of 20 on growth, and 0 out of 20 on smart money indicators. Now, valuation. The question every investor has to answer: are you paying the right price for this asset? China Construction Bank is trading at a price-to-earnings multiple of 6.23 times trailing 12 months earnings, with a forward price-to-earnings of 6.00 times. These are historically compressed multiples. The bank's PEG ratio, which adjusts the earnings multiple for expected growth, sits at 0.72. In isolation, a sub-7 earnings multiple looks cheap. However, valuation must be contextualized against growth and profitability trajectory. The company's price-to-sales ratio is 3.25 times, and the EBITDA to enterprise value metric cannot be meaningfully calculated given the nature of banking balance sheets. Looking at the latest earnings results, the most recent quarter reported revenue of $211 billion against an estimate of $614.5 billion, a significant miss. However, net income came in at $86.3 billion, reflecting a net profit margin of 43.73%. This underperformance against consensus forecasts, combined with the structural revenue headwinds facing Chinese banks, suggests the market has rational reasons for depressing the multiple. Regarding fair value, our analysis indicates the stock is trading at a premium to intrinsic value, that is, above what the company's fundamentals would support in a discounted cash flow model. The consensus analyst price target mean is not currently available in our dataset, which limits our ability to triangulate a precise target. Taking both signals together, the depressed multiple offset by negative growth dynamics and margin compression concerns, a reasonable fair value range in our view sits between 0.90 cents and $1.10. This implies the stock offers limited margin of safety at current levels. Market sentiment around China Construction Bank leans moderately bullish, supported by optimistic earnings estimate revisions, though broader market sentiment remains mixed amid geopolitical tensions and economic uncertainty in China's financial sector. The next earnings announcement is scheduled for April 29, 2026, which will provide an important catalyst to reassess the thesis. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point health checklist measuring profitability, leverage, and liquidity, comes in at 5 out of 9. This is below the threshold of 7 that typically signals financial strength. The score suggests mixed health signals, some positive metrics offset by areas of concern. The Altman Z score, a bankruptcy risk model, reads 0.00. This is a distress signal. For traditional manufacturers, a Z-score below 1.8 indicates elevated bankruptcy risk. For financial institutions, the formula differs, but a 0 reading warrants serious caution. On the leverage front, the debt-to-equity ratio stands at 0.77. This is moderate, not dangerously high, but meaningful. The cash-to-debt ratio is 1.41, meaning the bank holds $1.41 of cash, or liquid assets, for every dollar of debt obligations. This suggests adequate short-term liquidity. However, the current ratio, which measures immediate liquidity, reads 0.00, a red flag suggesting potential near-term payment constraints or accounting classification issues specific to banking operations. The interest coverage ratio, a metric showing how many times operating income covers interest expense, cannot be meaningfully calculated for this institution, as interest is both an income and an expense line item in banking. The overall picture is one of constrained strength. The balance sheet is not in acute distress, but neither does it project fortress-like confidence. Regulatory capital requirements and deposit flight risk are the real concerns for a Chinese lender in this environment. Next up, profitability. Is this business actually making money efficiently? Start with return on invested capital. This metric measures how many dollars of profit the company generates for every dollar of shareholder equity and debt invested. China Construction Bank's return on invested capital reads 0.00, which is not a true reflection, but rather a limitation of the metric for financial institutions, where capital deployment and returns are structured fundamentally differently than in manufacturing or tech. The more relevant profitability measures for a bank are margins and returns on equity. Gross margin and operating margin both read 0.00, again reflecting the nature of banking accounting, where interest income and expense are netted rather than stated separately. The net profit margin, however, is 43.73%, exceptionally high. This means that for every dollar of revenue, the bank keeps 43.73 cents as profit after all expenses. In isolation, this looks outstanding. However, the margin appears inflated by the specific composition of the most recent quarter's earnings versus revenue reported. The free cash flow margin reads an eye-catching 249.60%, which is not economically plausible for a real-world business. This indicates a data quality issue or accounting artifact in how banking cash flows are classified. The return on equity, which measures profit as a percentage of shareholder capital, is 9.50%. This is modest for a bank and reflects the capital intensity of the business combined with the compressed earnings environment. The return on assets is 0.76%, thin margins relative to the asset base. The takeaway: profitability metrics are mixed and somewhat obscured by banking accounting conventions, but the return on equity in the low single digits suggests the bank is generating limited profits relative to the equity investors have deployed. Onto growth: is this business expanding and at what rate? The news here is sobering. Revenue growth over the trailing 3 years is negative 0.90%. and revenue growth over the trailing 5 years is negative 1.10%. Let that sink in. The bank's top line is shrinking. This is a secular contraction, not a cyclical dip. The most recent quarter reported revenue growth of 12.70% year-over-year, which appears to contradict the multi-year decline. This suggests either a comparison against a depressed prior year quarter or a reclassification of revenue items. The single quarter's growth does not override the concerning trend across 3- and 5-year periods. Book value growth, the expansion of shareholder equity per share, sits at 7.20% over 3 years. This is positive but modest, indicating the bank is growing its equity base slowly. Dividends are relevant for investors focused on income. The dividend yield is 4.74%. which is attractive in absolute terms but must be contextualized against the risk of dividend cuts if profitability deteriorates further. For a mature financial institution in a slowing economy, dividend sustainability is paramount. The overarching picture is clear. China Construction Bank is a mature, consolidating business in a challenging macro environment. Management has not guided to return to positive revenue growth in public disclosures available to us, and the underlying dynamics, deleveraging, regulatory pressure, and property sector stress, suggest headwinds will persist. Growth is not a source of upside to the investment thesis. Now let's talk smart money. What institutional capital is actually doing with this name? The data here speaks volumes. 0 top-tier gurus, as tracked by Dataroma's database of elite investors, currently hold China Construction Bank. This is a striking signal. Warren Buffett, who has substantial experience with Chinese banking and has held positions in Chinese financial institutions, is not a current holder. Neither are other marquee names in the value investing space. This absence is telling. The smart money has largely exited or avoided the name. Insider ownership stands at 0.00%. Management owns essentially none of the company's shares. This is a red flag for capital allocation and management alignment. When executives have skin in the game, they have incentive to manage for long-term shareholder value. The absence of insider ownership suggests management may lack conviction in the company's prospects, or, alternatively, reflects governance structures where executives hold non-voting positions or compensation in non-equity forms. Over the last 3 months, there have been 0 insider stock purchases and 0 insider stock sales. Flat activity. When there is no insider trading activity, whether buys or sells, it typically indicates management sees no clear catalysts for near-term repricing. The 13F filing direction, the aggregate buying and selling by institutional investors, shows 0% buys, which means institutional capital is not building positions on balance. The takeaway is unambiguous. Smart money is either underweight or flat, with no conviction to add. For a stock that is already challenged on growth and profitability, the absence of institutional buying is a significant negative signal. It suggests that large, sophisticated investors see better risk-reward opportunities elsewhere in the financial sector or in broader markets. And finally, the verdict. Let's bring it all together. On valuation, China Construction Bank trades at a compressed multiple, but given negative revenue growth and elevated risk, the stock appears fairly valued to moderately overvalued, not a compelling entry point. On financial strength, the balance sheet is adequate but not fortress-like, with a depressed Altman Z score warranting caution on credit stability. On profitability, the bank generates reasonable net margins, but return on equity is underwhelming for the risk of a systemically important lender. On growth, revenue is contracting on a multi-year basis, which is the most concerning fundamental signal. On smart money, institutional investors are absent or underweight, reflecting their own pessimism on the outlook. In our view, a fair value range for China Construction Bank sits between 90 cents and $1.10, representing limited upside or downside from current levels of $1.04. The latest earnings quarter showed revenue miss against consensus, though net income remained substantial. A reminder that accounting earnings can mask underlying business deterioration. The thesis here is cautious. China Construction Bank is a mature, systemically important institution navigating a structurally challenged operating environment. The stock is not screaming cheap, nor is it so expensive that a turnaround would create outsized returns. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on China Construction Bank Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.